Hello traders, it's 3:32 p.m. Central US time on Thursday, the 16th of August 2018. This is another study hall session. The topic of today is really a huge one. I'm going to try to cover it in under an hour, at least give you the tools that you may need as a trader to look at things a little bit more professionally. One thing I'd like you to note is because of the extent of the topic, I'm not going to be taking questions during the conversation, the discussion here, or the lecture, I should call it. I hate calling it a lecture. That makes me a teacher. But as I go through the material, I need to stay focused on the elements that you need. This is one of those videos that you're going to want to watch multiple times, I believe. So we'll run through the end. If we have time, we have not consumed an hour, then Yoda is going to help out by flagging up questions and offering them up to me at the end. If not, then we'll excuse ourselves and shut down, and we'll have to pick up the topic at another time depending on the number of questions generated. First, remember, derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. Make sure you have a lot of caffeine here and know it's the end of the day. We try to avoid webinars at the end of the day because we're all exhausted. But here we go. What will we cover today? We'll talk very briefly. This portion of the talk here is I'm going to try to blow through it really fast. We're going to talk about types of risk, the role of capitalization, sizing for risk management, being aware of market sentiment and why, event-driven market risk, handling economic releases, volatility risk, and opportunity risk. With the focal topic, the one I want to spend more time on, is putting together a risk plan. And not only, one of the things that I'm very sensitive to and want to avoid is to just give you answers. Not interested in giving you answers. I'm not going to make you help you become a professional trader by just handing off answers. The goal is to give you the background and help you understand why the conclusions that I've come to exist so that you can refute them or use them or do what you want. Because in the end, once you put on the trade, you have to be the biggest believer in your trade in order to hold on to it and sleep through it and not get up an hour early and freak out about it in the Russell, like one person we know from the chat room. Types of risk. There are two kinds of risk that we care about. Information risk, and this basically describes trades taken with a focus on price, on getting a better price without waiting for more information or confirmation. People constantly say, I'm waiting for confirmation to get short. And that's all well and good if that's part of your plan and you've accounted for a wider stop and so on. But confirmation, the old saying in the pit is confirmation is for Catholics only, not for traders, although there may be Catholic traders here. We don't want to wait for too much confirmation because it leads us to the worst of the two risks, which is price risk. And price risk means that you're waiting for more confirmation to get more certainty, and the cost of certainty is a better price. So statistically speaking, if I was to take more trades with a tighter stop and better targets with less information, then in the long run, I'm probably better off than taking trades that have more information, a wider stop, a smaller target over and over and over again. So my goal by using things like order flow and so on is to get as close to information risk as I can with as little price risk as I can. Okay, so I try to get in before the market has already failed, before the sellers step in and aggressively, before the big rotation down. That's my goal. So two kinds of risk, information risk and price risk. We want to take prices that give us an advantage for the least amount of information possible. Think of yourself as a pilot or as a marine sergeant leading a squad. You don't want to sit there and wait for information and wait for information and wait for information to the point that the risk of you getting killed or getting your passengers killed or whatever. You want to get as little information as you can, or just enough information to make a decision to move forward and live with that decision. The outcome's 50-50. The next thing I want to talk about is the role of capitalization. We can talk about risk till we're blue in the face, but if you're someone who's listening and you're trading crude oil with $1,500 in your account and you're looking to make a career out of this, then we have some disappointing things to tell you. Statistically speaking, capitalization is your biggest obstacle. Coming in with not enough money to really make something of the returns, the risk that you have to take really doesn't get you anywhere. In order to size for capitalization, there are two things you should know. Now, exchanges, especially the CME with its span margin, it's like a global standard now. Exchanges set margins. Margins are simply a guarantee, a deposit for allowing you to take more risk in terms of leverage than you have in cash. And there are two types of margins that we need to be aware of in understanding risk in futures. There's initial margin, which is reported by the exchange. Initial margin is what's required by the exchange. Now, your broker or your clearing firm can offer you intraday, lower intraday margins. $500 per contract in index products is very popular, very stupid, but it's very popular. That gives you an insane amount of risk to play with. I mean, if the ES is at 2850, the notional value of the ES is 142,000, and you're trading that with $500. That's 285 to 1 risk factor on those trades. But the exchange knows that it's very unlikely that the value of the ES, the NQCL, or whatever will go to zero, and it allows you to trade with just initial margin. Initial margin is required for the session in which you initiated the trade. So if I put on an ES contract today on the 16th, I, by the end of the session, must have the full initial margin required by the exchange, which is currently $6,380. Okay, I have to have that in my account in order to hold on to that position and not be on margin call. Now, once the new session begins, then I have to have maintenance margin, and the exchange is constantly assessing and recomputing margins when there's a big enough change. So back in April, margins went up from, I think, $5,200 per contract initial to $6,380 because of the increased volatility, and they have not reduced them, which is kind of surprising actually, because volatility's gone down. They have not reduced them since. Maintenance margin is what's required on the next session. So once I get through the first session, which is the highest risk you have is when you first put on the trade. Once I get through the first session, the next session, I'm only required to keep 90% of the initial margin, and that's called maintenance margin. For the ES, that's $5,800. Okay, so simple concept. To understand how margins are computed, just for your own information, the exchange takes a 3 sigma move, which is about a 99% move in range on any given day. So it looks back historically, a certain period of time, and it says, how many dollars do I have to survive a 3 sigma move in this particular product? And in the case of the ES, based on the current margin requirement, they're basically saying that the ES can move about 125 points to cover a 99% event. So you're covered for 99% of events that occur in the exchange, and that's what margins are based on. Remember, margins represent risk, and capitalization should be based on margins. It is best for you, It's best for you, even though you may be a day trader and you're not holding overnight or whatever. It is best for you to maintain a minimum of the initial margin per contract. You may trade more than that, maybe, but it's wise to just use the initial margin as an initial definition of what your risk is for that particular product per contract. I hope that makes sense. And that's why I'm covering it, okay? The next thing I wanted to cover, and I guess this is just another example. Sorry, I need to turn off my phone here. Let's say you have $20,000, a simple division, 20,000 divided by 6380. You should never put on more than 3 ES contracts to stay on the safe side. And why am I saying the safe side? Why am I against $500 margins? It's because my goal, as it should be yours as a professional trader, is to survive your losing streaks. And the way to survive your losing streaks is just to stick to the exchange margin. It'll automatically have you reduce your size as you draw down your account. We all do when we're learning, and throughout our career, we're going to draw down our account. What are the consequences of falling below this? Let's look at, I'm going to show you some examples of simulations, some just randomized simulations of what things look like when you have different levels of capitalization. So this is a Monte Carlo, this is a kind of a randomized simulation in addition to a portion that is basically Monte Carlo based. Let me just turn off the automatic calculation so this thing doesn't drag. But this spreadsheet, thanks to Tendex, with Tendex's help, he was able to help me create the Monte Carlo portion. But I created this with a simple idea that given the starting capitalization, given the risk percent of that starting capitalization with a minimum of $50, because that's the minimum we can risk, is maybe 4 ticks per contract, with a, let's start with a 1-to-1, risking 1% of initial capital. And with a this column here is a random run of wins and losses, okay? And the percent win can fluctuate between about 40 to about 55% or so, okay? And what this cell here tells us is how many trades can we take before we hit $500, at which point we can't trade anymore. So in this particular setup here, the trader was only able to take 96 trades with random wins and losses. You can see that they started out pretty good here with a 6-win streak, which is unlikely, but then things went downhill. And at a $1,500 with a minimum of $500, so below $500 you can't trade anymore. Anything above that you can risk 50 for a gain of 50, and it's just randomized. And we run through this, and as I hit F9 here, you'll see samples of what could happen. So let's count the number of times just by the graph. How often does the graph go to 0 given these parameters? $1,500, 1-to-1, so 1R risk, $5 in fees for each trade with a $50 minimum, okay? So if I run through this is one sample, that crashed at 334 trades. This particular trader bombed out and is done. Okay, so that's 0, 0 and 1, 0 wins and 1, 0 wins and 2. So this guy got 514 trades before it crashed. The third sample, 0 and 3, 298 trades. And this person ended up pulling off 926 trades before they lost their account. Okay, so that's 0 and 4. And there's a winner, 1 and 5, 2 and 6, 2 and 7, 2 and 8, 2 and 9, and 3 and 10. Now, if we want to run that 1,000 times, here's a run of 1,000 times, randomized simulation. The results are pretty bleak. Okay, the average is a return of 13%. The win rate's 48.2 with an average of 692 out of 1,000 trades executed. Okay, the best they did is 365% return. I was going to convert this to an account size, but I didn't get around to it. The best they've done is 365% return with a 55% win rate. The median's 47% loss on 1,000 contracts, 1,000 trades. Okay, now let's move this up and say let's trade the entire initial margin. So we move to a 1-to-1 to a 1R risk reward, and we start to look at how often does someone with a higher capitalization, a full initial margin, how often does that fail in 10 runs? Now we can see the results below for 1,000, but let's just run it, hit F9 and keep computing. So there's 1 and 1, 2 and 1, 2 and 2, 3 and 3, 4 and 4, meaning 4 traders we've bet on for 1,000 trades, and none of those all four avoided crashing like you saw earlier. 5 and 5, 6 and 6, 7 and 7, 8 and 8, basically flat. 9 and 9, 10 out of 10. 10 out of 10 survived on a 1-to-1 risk reward on random outcomes with the initial margin. So what is the point of this? The point of this is capitalization makes an enormous difference. It's better to stop trading, earn the money, come back, execute your edge, even if it's, in this case, it's random and there are many factors we're not accounting for, like psychology is a big one, but capitalization on a baseline is the minimum requirement. And if you look at the 1,000 sample simulation here, the win rate's 50%. Pretty much the entire range got 1,000 trades. The whole 1,000 trades were measuring by with a variety of returns, some positives, some negatives, okay? But overall, not so bad. If you change the gain loss, things become dramatically different. So let's say you have a $1,500 account, $2,000 account. One of the things you have to do then, which is very difficult to pull off, let's go to $2,500, is to skew your risk reward. Okay, you have to come up with a plan that skews your risk reward to survive the fact that you're so undercapitalized. There's a crash there, so 1 and 2, and so on. I don't want to spend too much time on this, but these people end up surviving a little bit better. You're still undercapitalized, but you still get to about a 50% chance of surviving based on capitalization alone, all other things being equal, including the randomization of results. This should have a strong impact on your view of how important capitalization is to risk. So we can sit here and talk about risk plans. We could talk about regressive risk management and so on and so forth. And none of that means anything if you're undercapitalized. Okay. So hopefully that's a very impactful portion of what we're talking about here. That capitalization is huge. The next thing I want to talk about is sizing for risk management. So the Monte Carlo simulation that you saw here shows that risk sizing is very important in terms of outcomes on a reasonable number of samples. We just use 1,000. Just remember, most traders, it takes you about 1.5 years to cover 1,000 trades, by the way. Assuming 2 to 3 trades per day, there are 252 trades per year. You're probably going to take off 3 weeks out of the year. So that's 15 days, 15 days down. So 235 days times 2 to 3, let's call it 3 trades per day. That's about 750 samples, 700 to 700 samples. So to get to 1,000 samples, it takes about 1.5 years. So with that being said, even if you're undercapitalized, the only way out is to skew the risk reward and then to stick with the required increase in size as your account increases in size. If you stay constant, then you do not get the compounding effect of what the curve shows. Commonly, traders focus huge amounts of energy on avoiding losses. In doing so, they skew the sizing equation because there's an urgency to bank profits when they see them. This means that the R factor of a trade is generally inversed. What is the R factor? R is simply a measure of how many times the risk are you getting in reward. So if you're getting 2 points for every point that you're risking, then we're saying you are using a 2R risk plan. So when we're talking about risk, we want to always refer to it in terms of R, okay? And what happens with most people, especially at the beginning, since you're having a hard time believing in what you're doing and having the confidence in what you're doing, generally you're going to find yourself skewing that R factor so that when you see a win, you're going to bank it and then you're going to take your full stop, as opposed to taking your full stop but also allowing your trade as long as it needs to take to finally attain its target. A trade attaining its target is the only way to really get close to matching what your edge truly is over a large sample. It makes no sense for most short-term traders to use any risk factor lower than 1R. So if you start playing around with, you know what, I think I'm going to risk 1 and my return is going to be 0.75. Okay, let's see, 0.007. Like that. What happens over time, well, actually, that doesn't look too bad with the Monte Carlo in this configuration. That doesn't seem very right. But in most cases, having less than 1R is a very tough thing to overcome. Remember, your targets, when they get triggered, they're getting triggered on an offer. In other words, you are in the queue. Your stops, when they get triggered at the market. It's really hard to overcome that one tick disparity between your risk and your reward. And so you want to stay to 1R or better in order to overcome this. Otherwise, your win percent has to really come up. You have to be right a lot more in order to overcome this. It is your duty to check to make sure that a given trade provides room to attain at least 1R as a factor, as a key factor of executing it. And I have a spreadsheet that I'll share with you that helps you assess that. The other factor in risk management is the size. The size the trader should trade falls under 3 constraints. One is capitalization. You don't want to bet more than 1 to 2%, 2% on the high side if your account's small, of your account equity on any given trade. Okay, the risk of ruin on higher than that it becomes really dramatic and the curve is exponential. The amount you need to bet per contract, the second constraint is the amount you need to bet per contract so that your targeted stop zone is outside of the harmonic rotation or volatility of the product. In other words, you don't want to bet You don't want to bet that 4 ticks on 4 lots when you need at least 8 ticks of room for the trade. Let's say you're trading a product that requires at least 8 ticks of room. You don't want to sit there and trade 4 lots with 4 ticks, a total of risk of 16 ticks. Instead, you want to bet 8 ticks on 2 lots as a minimum if your capitalization allows it. So that's the second constraint on how you size your trade. The third, and really the toughest constraint on sizing trades, is your risk tolerance. Don't bet on a size that would cause a lot of chimp noise in your mind. You don't want to bet on a size that causes you to get sweaty and to become really nervous and you feel like you're going to throw up. Believe me, I had that experience. So you constantly have to, weigh the capitalization of the. So if, for example, if you decided to deposit $1 million and with 1% of risk, it's $10,000. With an 8 tick stop, you might be able to trade, I don't know, I didn't do the math on that, probably should have. With an 8 tick stop, that's $100. So you can trade, what is that? 100 contracts? I don't know. I don't know if that's correct. But do you have the stomach for 100 contracts? Do you have the stomach for a $10,000 loss? Can you handle that? Are you able to stay focused and stay disciplined? That's the third factor, and that's the hard one. So as you do a Monte Carlo simulation or look at these things and you base things on a percent of capitalization, one of the factors that kicks in at some point on winning streaks is, will you keep increasing your size as the program dictates? And that's the third constraint, okay? So you always want to trade with a comfortable size that you can manage just like you would any other size. For example, if I'm trading 12 contracts or 24, I kind of have the same response. Once I put on a full unit of 48, it's really got my attention. I don't want to go beyond 48 unless something dramatic or something really telegraphed happens, like yesterday's drop. I don't go beyond 48 unless I have the confidence that overcomes that additional jitter, that additional noise that I would have trading the bigger size, 48 to 96 or something like that. So again, that's a factor. Sizing for risk management. What risk control scheme do you want to use? Do you want to use a progressive scheme, a regressive scheme? I'm not going to cover those because I just don't have the time. Let's keep it simple. Will you be putting on the trades all in, all out? If you're trading 1 contract, you don't have a choice. But if you're trading 2, are you going to do 2 to enter, 2 to get out? Or will you be doing 1 plus 1, because we all know that you cannot be that accurate with your entry, so you're allowing yourself room to improve your entry, so you're doing 1 and 1, and then you're getting out 1 and 1. Or are you doing 2 in, 1 out for scale, 1 out for target? That's always been my preference, especially for those who are not consistent, and so on and so forth. What planned moves will you make with your stop and targets once the trade has been put on, right? So are you doing an OCO or a bracket and you're putting those on and they're fixed? Or are you actively managing the trade, therefore you're not putting anything out and then you're just waiting for the target distance and then just hitting the market when it's there? Are you doing the same with your stop or using hard stops? That's all part of your risk management plan. And you have to decide that. And a lot of that are just factors that have to do with the way the product trades and its liquidity, but also on your temperament and how much attention you can give to your trades. Why is moving a stop to break even such a bad idea? I hear a lot of people going, yeah, I got in and it moved to 2 points in my direction. So I scaled out for 2 points and I moved to break even. The probability that the market, after a short distance, allows you to move your trade to break even and for you to survive a rotation back to break even that takes you out is very, very low. You would have to have caught the beginning of a trend to move to break even if you're not beyond 2 rotations. Is anybody confused about what a rotation is and what do I mean by 2 rotations? Just let me know. Most traders focus on how much they can make on a trade until it is executed. Now, think for yourself for a moment. The reason you're putting on a trade is because you think you're going to make money. So your focus is how much can I get out of it? But I bet that if I connected to your brain and was able to read your thoughts, as soon as you put on the trade, your appetite for your target is almost completely gone, and the main focal point inside of your head is on how to avoid the loss. This is a demon that everybody has to deal with. We enter because we believe we can make money, so our focus, I mean, why? You're not stupid. You're not going to enter believing that you're not going to make money. So you have to have convinced yourself fully and completely that you're going to make money in order to enter the trade, right? And so as soon as you enter, however, the market doesn't, now you're dealing with the reality of how the market gets the targets and stops. And all of a sudden, you're looking for signs and ideas and changes and things you may have overlooked when you are calmly analyzing the market before the trade. What have you overlooked that could lead to you being stopped out? And so now you're watching carefully to see if you were wrong about your assessment and what you should do to prevent a stop. Let me just close it for a tick loss. This looks horrible now. Strange. It looked great before I got in and then immediately looked terrible. And the fact is, how do you prevent this? The fact is you cannot. What you have to do is transcend that type of thinking and recognize that, you know what, your stop and your target probably have an equal opportunity of getting hit on this trade. There's just no way to know. You cannot take away the uncertainty. You'll hear me say that a billion times again and again and again. It's just a fact. And so whatever got you in the trade is the thing that you need to focus on. So turn your eyes, as part of your risk management plan, is to turn your eyes away from the flickering of orders and from the movement inside the dome, and to go back and look at the overall market context. The higher time frame chart you can move to, the better. Okay, so the way to prevent this is to understand that, there's nothing about this trade, assuming it's sized properly, there's nothing about this trade that makes it so that the stop is more likely to get hit before the target. And on this particular trade, it's really, truly random. So don't worry about it. Okay, you can test this by just flipping a coin in a simulator and putting on a trade at some random price with some random targets and stops that are equally apart. You'll see how that works. What moves are you allowed to make with your stop once the trade is on? That's something else that your risk management plan has to address. What are the moves that you're going to make with your stop once your trade is on? How long do you hold on? Is there a time stop? Does the market have to move a certain distance for you to move your stop, and so on? The next thing I want to address really quickly is market sentiment. So for those of you who attend the Trader Bite every morning, one of the first things I cover is market sentiment. Okay, what is the risk sentiment for the day? And in general, the market's either allocating to risk. Money is always moving around the globe. It's constantly moving. It's either being allocated because money's got to work, or else the owners of that money are going to pull it and give it to someone who will make it work. So program managers and investment managers and chief investment officers all around the globe, and all banks and funds and so on, have a huge incentive to keep your money working constantly. And in order to make it work constantly, they have to assess and manage risks constantly, because not only do they not want to lose your money because it's inactive and you believe you can have it make money elsewhere, so there's a loss that way. But there's also the real loss of losing your actual money and impacting not only you, but everybody else by taking a loss in their fund, which forever is going to appear in its performance, history. And so funds are highly incentivized to keep money moving. Okay. And the not because they want to generate commissions, because that's not really how they make money. They want to keep money moving because they want to make sure that whatever risk they have on is also protected by using instruments like options or futures, ETFs or whatever. And so there's this constant risk sentiment, right? And given all of the information that all the smartest people in the world who are managing money collect, when we come in, there's a certain risk sentiment. Is it allocation to risk that is strong? Is it mildly allocating to risk? Is it even or mixed? Is it mildly allocating to safety, or is it heavily allocating to safety? Okay, so when we gap down, we come in, we see that money has flowed to the U.S. bonds, the U.S. 10-year note, the bund, the yen, gold, and so on. Euro sometimes, and so on. You see these allocations, just money just moving into those areas, and you'll see that money is being pulled out of the indices in the overnight session. And coming in, you need to be aware of what the risk sentiment is. It's not going to color your particular setups. It's not. It's simply going to help you assess what the OTF is likely to be doing today. Are they going to be pushing directionally like they did today, gap up, unable to touch the open, risk on? From risk sentiment is on from the very get-go, like I talked about this morning, unable to close the gap, so up, 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 up we go. It would be a terrible idea for you to ignore what that sentiment is. Your risk is much higher. Overall risk allocation by the larger participants should inform your overall level of aggression on your bias and help you decide if today is going to be a day where stops have to be wide due to an imbalance or narrow due to a balanced chop market. Okay, so you need to be flexible in assessing how your risk is being allocated, just like the way these larger institutions are allocating their risk. There's also event-driven market risk. So we've been living in this event-driven market risk a lot, right? As a trader, you must be aware of what event risk is present in the market. This shows up in the form of M-plan news events that force institutions to hedge their risk. Trade talks and a president that's tweeting and an argument over such and such, potential missiles flying, whatever. Event-driven markets tend to require much more disciplined stop execution. You need to be keenly aware of what events are driving the market. Potential war in a country that is an OPEC member or an heavy oil producer. Well, that's event-driven risk in your crude oil trading. So you need to understand that today you need to cut your size down to a 1 lot if you're only trading 2, or if you're trading 4, then you need to go to 2, maybe 1. That volatility, you don't need to wait for the day to finish to recognize that there could be a lot of volatility, and you compensate for that by coming in and seeing what events are likely to drive the market. There are some days where the market responds to certain events, and then there are some days where it just completely ignores them. Okay, daily loss limits are imperative on event-driven market days. Okay. Economic releases is another portion of your risk issue. Wow, I've taken up a lot of time talking about this. Are you aware of all the scheduled releases? Are you aware of the market impact for each release? Do you care in your product what the jobless claims are? Does NFP matter, or are you more impacted by the crop reports? Do you have any idea of the impact on pricing for your product for a given release, or is it benign? Make sure you're using a good calendar. If you don't know of one, drop us a note. We'll make a recommendation. And then finally, for this segment, handling economic releases. How are you managing risk into an economic release? This is really important because First, you need to be aware that there are economic releases. I don't cover them as much in my Trader Bite, but it's public knowledge. You should know what's coming out that day. You should be keenly aware of it, especially during earnings season. You need to know when the earnings are coming out, what the expectations are, and what that particular stock might do to your product. If you're in the Nasdaq, you want to pay attention to Google, Apple, Amazon, Tesla, and so on. Netflix. Here are some guidelines that I want to share with you to consider on the aspect of how you manage economic releases. Let's say you're holding a position and there's a 10 o'clock Eastern US number that's coming out and the market's now open and you put on the trade. If you're holding a position into a number that doesn't have at least cover 50% of your risk, so you haven't covered 50% of your risk at this point, and it's not 2 rotations away. So rotations in the ES, each rotation is about 3.25 points currently in the ES. Okay, if you have not taken 50% off and you don't have at least 2 rotations from your entry, okay, so about 6 points, then you need to close the position with 30 seconds before the number, at least 30 seconds before the market gets thin. That's my recommendation to you. Use it or lose it kind of thing. It's up to you. If a position holds this criteria, then you must have a break-even stop and expect to lose at least 1 rotation. So even though you have a stop at break-even and the market's 2 rotations away, in other words, from your entry, the market's up 6 points, and you put a stop at break-even, you still should consider that if your stop gets triggered at break-even, it might go through by 1 rotation. You have to factor that in. Okay, so you're not surprised or disappointed for your next trade, and that's a lot of what we do with risk management is we're shielding ourselves from the impact from this trade on the next trade, because the next trade has no connection with the current trade except your brain, your emotions. In either case, have a written plan for what you'll do in this situation. Volatility risk. A lot of words here, but if you're not making up for volatility risk as part of your risk plan, then you're ignoring a huge part of what risk is all about. Volatility in the market's not constant, it's constantly changing. So volatility collapses, it means that you'll likely have fewer opportunities, but you can also use tighter stops and have a higher position. So if you use a 2% or 1% risk value of your account equity, but the stop is now half, then you can trade twice as big and maintain that 1%. Okay, but if volatility increases and you decide to maintain the same stops and the same size, then you're likely to be disappointed that day. You're likely to have your stop triggered. So if volatility is such that, like back in February in the ES, volatility is such that the harmonic was somewhere around 5.5, 6 points, and you're still using a 2.5 point stop or 3 point stop, then you're going to find that you're getting stopped a lot. So what you have to do in that situation is either trade something else if your account size doesn't allow it, or cut your risk in half by downsizing in half and doubling your stop size and doubling your targets, because your risk reward has to still be balanced. And with higher volatility, you should be able to make up for that. I prefer higher volatility environments. A lot of people can't trade in higher volatility because they don't have the equity, or they feel that it's more risky. It's not more risky, it's just maths. Volatility doubles, your risk doubles, so your size has to be cut in half. So the net results is your risk is the same. You just have many more opportunities in a high volatility environment. A low volatility environment, I might see 1 setup a day. So it's a binary. I'm going to win on the setup or I'm going to lose the next time I have a setup, maybe tomorrow. In a high volatility environment, I might get tagged on a stop more times, but I have 6, 7, 8, 9, 10 setups versus 1. I prefer the higher volatility environments. I recommend that you check the harmonic rotation of your product at least once a month. If you're using IRT, we have shared this definition here where you can input the parameters for your product. I use 20 sessions, meaning 1 month, on a 1-minute bar chart, 5-bar fractal, and the minimum tick size of 0.25, and it tells me that here's the 1 sigma rotation for the ES is 3 1/4 up and 3 1/4 down, so that becomes the harmonic. Okay, so that tells me what the volatility is currently, and I check that about once a month. So it's important for you to keep up with that. The other thing is you can be keenly aware of daily ranges. So I'm also tracking daily ranges. If you use our chart definition for the composite chart, it'll tell you what the daily ranges are. The composite right here. So this is the daily range right there. And we know that currently the range can be anywhere between 7 and 23 points, 68.2% of the time, or 1 sigma. So 68.2% of the 776 days tested, the range falls between 7 and 23 points. If a day comes in and it's above this, whatever this purple line is, and it does so consistently, I know, like in this area here, that holy cow, volatility is really high. It's double or triple what it normally is. So lately we've been tagging we've been stopping right on top of this 1 sigma, but it's still normal. I don't need to make any adjustments. It's fine, just the way it is. A metric available to Convergent members also is the historic volatility closing bands. I post them every morning in the head traders room, and it gives you the close to close, the pit close to pit close bands for where volatility is likely to fall. If we start to see that the market's exceeding, 150% or 125% of what was expected on a daily basis, we know that something's changing, and therefore my risk plan must change. This sheet here is available in Market Studies. It's pinned, and it's also available, I believe, in our downloads area. I'm not sure, but this is kind of getting old now since April, but this gives the harmonic rotation for each product. The upper band, the lower band, you can see this is pretty high, 28 ticks, and it gives you an idea of what the harmonics are for each product in terms of ticks. Okay. Opportunity risk. Well, actually, this is the last topic. Opportunity risk, something we don't think about, but if you're someone who's picking out which trades to take, which setups to take, which setups not to take, based on how you feel that day, based on how the last trade went, and so on, there's a huge opportunity risk that's part of your risk management that you need to get on top of, and that is, you skip every setup after a losing trade so that you can give yourself a break and not stress and so on. But you're choosing these setups randomly, and so you are creating additional risk to the downside, because the best opportunity, generally, in my experience, the best opportunities occur right after a stop out. A stop out is a piece of information that you can use. That's the thread between the last trade and the current trade. The thread between them is the new information you got from being stopped. You were in this trade, you were involved in it, you could see how aggressive the market was about taking your stop out. You're in a better position than anybody else who is standing by and not in a trade to assess how the market movement goes. A lot of people just cannot put on a trade right after they've been stopped out, and that creates an additional risk, and that is the opportunity risk. Using a random selection process for trades just cripples your ability, the ability for your edge to show up statistically. One second. So how do you confront that? You confront it by defining what you need to see to engage with the market, checking it out on a simulator to make sure it has an edge, of course, and then to come and just take the damn trade. Just take it every time. Don't introduce opportunity risk into your plan. So Real quick, I'm going to cover the minimum items you have to have as part of your risk plan, and I'm providing this template to you to use at your own risk. Here it is. Very straightforward, very simple. The first portion covers the capitalization. So if your account has $850 to $8,250, and you're risking 1% per trade, your risk is $82.50 for your particular product. You can enter your harmonics and all that good stuff to figure out what sizing you need to stay out of trouble, to stay out of trading within your within the product's harmonic rotations. And as you can see in this example, the minimum risk per contract you need, given that this product has a rotation of 13 ticks, a harmonic rotation of 13 ticks, you need $162.50 of risk per contract. So if you're risking $82.50 as 1%, then you're either undercapitalized or you're not taking on enough risk. Increasing this from 1% to 2% can theoretically cut the number of losses you can withstand, not by half, but a little more than half, like 60%. It's not really half. If I go from 1% to 2%, I get less than half the trades. If I go from 1% to 3%, I get less than a third of the trades or the opportunities if I hit a losing streak, because it compounds. It's a curved it's a parabolic equation, compounding equation. So in this case, you put in a spreadsheet that the harmonic is 3 1/4. You have 82.50 to trade with. You need to stop 3 1/4 points, 13 ticks on one contract. You cannot put on this trade. This trade is the stop is too wide to maintain this risk. So the only thing you can do here is go trade something else. So you have several options. Go trade something else that does not require as much money because of the harmonics and its tick value. So you need to go and look at the Dow or look at M6E or something else, or 6E or something. The second option is to add equity. And the reason you'd want to add equity is because it increases your probability of surviving. It decreases your risk of ruin to keep things at 1%, right? Just as I discussed, on a bad losing streak, 1% isn't going to give you a high risk of ruin. Or the third option is to increase the amount you're willing to risk. So if I go from risking 1% per trade to 2%, the spreadsheet says, all right, you can risk you're risking 165. You need $162.50. You passed. So this is, you passed the capitalization test. Okay. The size that you're permitted is 1. So let's say I'm trading a $26,000 account. Actually, let me close the win-loss spreadsheet because this thing's a monster when it recomputes. And then let me switch this to automatically compute. Boom. Okay, so I don't have to keep. So if I go to 1% on 26,000, I still can only trade one lot. If I go to 2%, I can jump to 3 lots. Okay, because I can risk $520 and I need $162.50 minimum per contract, and so on. So this is something you can play with, and putting in the target distance. This is important. Putting in your target distance helps you define what your R factor is. So if I know that my target's 3.5 points away, then my risk factor is 1.08. Is this a trade that I can still put on? Yes, it passes the capitalization test, and my target is okay. It passes the risk factor test. Okay, if I can get a target, an average target that's higher, great. The next thing as part of your risk plan is you need to define how you're going to stop. Manage your stop. So stop location is 3 1/4 points from entry, defined by the harmonic. You can see this is carried over from here. Anything less than that, and you're basically scalping, which is okay. If you're scalping, something that starts to then feed into it is your win percent. Your win percent becomes a huge component of what you're doing here if you start to trade within the harmonic rotation or the ebb and flow of your product. It's still doable, but you start to have to increase, to become more accurate with your trades and increase your frequency as well, which increases your costs. And then you're going to define as part of your risk plan, what is your stop movement scheme? So stops can be moved to the last zipper bottom, plus 1 tick on a long. Actually, this should say minus 1 tick. Minus 1 tick on a long after one rotation has been cleared. So let's take a look at what that means. Again, I'm not telling you this is how you have to trade. I'm just simply giving you an idea. So let's say my trade is right here. So the market bounces up, bounces down, and the market comes back. And I didn't actually take this trade today, but let's say we entered right there. Okay, we automatically define a 3¼ point stop. We automatically define at least a 3¼ point target, whatever that is. Okay, so it's 39.75, so 42.75, which is somewhere around here. Okay, you automatically define that. When can I move the stop? I need to move through 1 rotation, 2 rotations, and now I can move the stop to the last rotation low. So this is zipper low. There's a tiny zipper in here. You can move down there. The market starts moving another rotation higher. You find the next zipper, which is right here, and you move your stop through here. Why am I even talking about zippers? Why do I even care about zippers? I'll tell you why. You want to place your stop where the market has to fight through to get to it. This is the ideal situation. In other words, you don't want to place your stop where the market can easily take it out. Okay, so where can the market easily take out your stop? 1, in the harmonic rotation, in the noise, it can easily take it out. 2, in a very, very obvious area. So last high, last low, that sort of thing. And the reason I'm looking at zippers is because this is an area where the market has consolidated and fought. And we saw a fight happen, back and forth, back and forth. There was a fight there, and it resolved in your favor. If the market gets through that area, and those people who fought that area of balance, the little zipper that was formed, if those people are not able, those other participants are not able to hold it, then you're probably wrong, and it's probably coming right back to your entry or to your stop. And so I don't use a trailing stop that is ATR based or nothing like that. I use a stop based on market structure, and so I look for consolidation areas. What do these consolidation areas look like? We can actually define them by clicking on this button here, and that is a horrible color. Let's change this color so that it's something you can actually see. Let's use volume shading. Let's use navy. Okay. And it's still a horrible color, but let's look at what this looks like. So if we look at these intra profiles, wow, why is it so ugly? Oh, I see, this is in front. So send to back, make these bars extra thin. So as you can see here, there's a zipper right there. You can see that there's a bit of fighting going on there. There's a bit of volume that goes on inside of these zippers, but in the areas where the market runs, there isn't all that much volume. And what I'm relying on is the participants in that zipper, the participants who form that volume to come in and still see value in buying or protecting those areas. And that's really how I'm doing it. Now, is that the way you should do it? I have no idea. I'm simply offering a template here to give you a minimum in case you don't have a risk plan. And then finally, As I said, stops can only be moved to break even after 2 rotations. Moving your stop because you got a target, got a scale out, is not cause. That's just you managing your emotions through your stop. And it's very likely that you are missing out on the big picture trade, which you have studied and set up and took the risk to take. And then here you are cutting yourself, shooting yourself in the foot by going to break even because you want to just sit back and go, okay, I can relax. You're not here to relax. You're here to exercise your edge so you can make money. That's what you're here to do. So I see a lot of people taking a 6-tick scale out, moving to break even, and then going, it took me out of break even and it went 6 points in my favor and my target was, well, no shit, Sherlock. Sorry. It just makes no sense. You need to let the market rotate through. Now, let's say the market does 2 rotations. You move to break even and it takes out your stop. This is okay. Your stop at this point should be hard to attain. If the market's able to move 2 rotations and you move your stop to break even and it comes back through 2 rotations, which means probably a zipper or 2, then your chances are it is something has changed. Something has changed. And so it's okay. It's okay. I keep trailing my stop when I can. It's not often that I catch a trend, but when I do, I use rotations. I use zippers to track it. I don't use like a fixed ATR or mathematical, and you can do that. That's fine. This is just what I'm sharing with you, what I'm doing. Okay. Stop ahead of event. As I talked on scheduled events, trades can remain open with a hard stop only after 2 rotations and 50%. 2 rotations and 50% of the position has been banked. Okay. If 2 rotations haven't cleared, then trade is closed 30 seconds before economic event. Okay. If you wait any less than, usually it's algos shut off in about 1 minute into an event. Anything beyond 30 seconds, I'm telling you, the market is just too thin. Even if it's EES, it's too thin for you to manage the trade anymore reasonably. Define execution management. That's part of your risk plan. Execute all in, scale out, all in, all out. Just put it down, write it down, follow it unless you change it. Okay. Risk scale out distance. You're going to scale out, define what you're going to scale out. You're going to scale out 12 ticks. Your scale out's 12 ticks. Your stop is 13 ticks. It's okay. And then you're defining that 50% of the size you initiated with will be scaled out. This is something you're already set. The reason we're writing this down and putting it down is so that you execute it without question, without thought, without process. It's already done. You're just following orders. Somebody wrote these orders down, you, and you're just following the orders that you wrote down, you. And so if you don't put it down, then it's subject to debate in your mind when you're in the trade. If it's written down and it's sitting on your desk, you know, dude, do this, okay? Order types, I use limit orders all the time. Even if I'm going to market, I just cross the offer to buy, cross the bid to sell, but I don't use market orders. I use limit orders regardless. Stops, I always use stop at market. You can use stop limits with a skew, risky because the market can run through and then you just have an offer sitting there or a bid sitting there instead of the trade being closed. Define streak management. So this is really important down here. How many attempts can you have on any given bias? So I want to get long and the market drops and I get stopped. And my context and everything I'm reading is saying get long. And I get long again. So that's my bias again, long. And I get stopped. Now I'm like, crap. And still the market bounces up. We have a big rotation up and then it pulls back to a key area that it just created, a market generated area. And I get long again and I get stopped. I am done. That bias is done. Even if it goes to the moon from here, I am done. I am not buying it anymore. I get 3 stabs per bias. That's my risk plan. And the reason is you don't want to be sitting there fighting a trend all day long. Market's selling off and you've lost money, and the only way you know how to make money is to fade the market. And so you're going to buy it, you're going to buy it, you're going to buy it. And then $2,000 later, you're going to buy it. $3,000 later in losses, you're going to buy it, you're going to buy it, you're going to buy it. I'm susceptible to that. You're susceptible to that. So make sure you understand that you have 3 attempts and you need to make them count. You get 3 pitches at a given bias. They need to count, okay? Daily loss limit. You have to have a daily loss limit. It's the only protection you have. It is your car insurance. It is your seat belt. It is your helmet on your bicycle. It is your travel insurance plan. It is, it's something that you don't want to have to exercise. It's an idea that you don't want to have to deal with, but you have to have it in place for your own protection. So do so, okay? So my recommendation is on the high side, 5% of account equity on a daily loss limit. And the daily loss limit really should occur about 3 to 4 times a month. So it's a rare occurrence that this should happen, and you need to adjust it. And so all I'm doing is I've defined it as 5%. I can define it as 6%, and it'll recompute, or 3%, whatever it is. 3% is too tight. So I'm basically saying if I'm risking 1% on each of these trades, that's going to be putting me pretty close to my loss limit for the day. But I don't want to exceed 5% of the day of my total account, because remember, if you lose 50% of your account, what percentage do you have to make back to break even? That's right. You have to make 100% back. So your account value has to increase by 200%, or the total account value has to be 200% of where it is. So you have to double your account every time you lose half of it. So you don't want this thing, you don't want to have it go out of control. So we create a daily loss limit. If you don't have one, be smart and get one, okay? And then a weekly loss limit, 3 losing days in a row. And I know this. I know that the markets have changed. So the current regime is changing, and I have not changed. So something has changed, and I need to change. That's what a weekly loss limit tells me. I run into a rough patch probably once or twice a year, I would say, throughout my career, and it results in me having to stop on a daily loss limit. If I hit a second daily loss limit, generally that's all I need to experience to tell myself, okay, I've got to scrap everything I have, start over, do research again, and figure out what has changed to cause me to read things so poorly. Okay, so, but on a weekly loss limit, 3 days loss, and you're done for the week. So if that happens on Monday, Tuesday, Wednesday, you're done. If it happens on Friday, then Monday, Tuesday, you're done for the rest of that week. If it happens on Wednesday, Thursday, Friday, you're done next week. Next week, you're going to be doing homework, you're going to be simulating, you're going to be sitting out. You're taking either the rest of the week off into the weekend or the full week next week. You've got to stop. There's something that is dramatically changing and you're not sensing it yet. It happens. And then the last thing I wanted to include in here, but it's a huge topic. It's regressive sizing. It's the idea that by the time you hit your daily loss limit, you should be you basically should be trading 1 lot. If I start out with 24 lots in the beginning of the day and I've lost 50%, I should be trading 12 lots. If I lose another 50% of that, I should be trading 6 lots. If I lose 50% of that, I should be trading 3 lots, and I should be hitting the daily loss limit at the lowest with the lowest amount possible. A lot of people disagree with this. Because their focus, they're seeing trading as a closed sample, and their focus is, well, if I'm down 75% of my loss limit or 90% of my loss limit, I should be trading the maximum size because I want to make money back. Here's the thing. you're a better person than I in terms of discipline, because when I'm at 75% or 90% of my loss limit, I am in no condition to sit here and take serious risk by putting on a full size again. Okay, so my goal is not to make money anymore. I've given up on that at that point. My goal is to get into alignment with the market. So I'm looking for 3 winning trades in a row and I double. 3 more winning trades in a row and I double. 3 more winning trades and I double till I get back to full size. My goal is to make my loss streak go on, give me as much opportunity to make the turn and ride the wave back up as possible versus making money back. So you're going to find a lot of pushback from quote unquote gurus and people who know it all about trading, because they believe that mathematically you should be trading the maximum when you stop out. I think that's total BS, because our minds don't work that way. Okay, trust me. The reason I can offer you this information, and I believe in my heart that it's better than anybody else, is because most people have done this in their office, in their basement or whatever, and now they're telling everybody how to trade because maybe they had one good year or something. It's a whole different ball of wax when you've back traders and you've had to deal with the stress that traders are going through with you and managing that. That's a whole different ball game, because a lot of people can figure out what to do when risk is on and versus their personality, so they can manage the risk according to their particular temperament. It's a whole different thing to help others. Remember, that's stage 5 of competence, to help others get to the point where they need to be in terms of learning and making the turn. And that's really the experience I'm bringing to you as a member here, which I believe a lot of people just don't have. A lot of mentors out there have never backed a single person, yet they're able to teach. Risk is the best thing that I do, and it is the key element of my entire existence as a prop shop owner, as someone who's back traders, is risk. This is my bread and butter. So I'm going to share this spreadsheet with you. It's very basic, very kind of simple. It's just what it's doing here is it's helping you think through the elements that have to go into your risk plan. In fact, let's set the print area here to make it easier for you.
Traders have asked if you also will be sharing that first spreadsheet, the win-loss randomizer.
No, that's proprietary. I cannot share that. And it really, it's I don't know how helpful it is, but you can create a randomized sheet like this, the Monte Carlo stuff and all that. It's really proprietary. It's not something that I'll share, and it goes into the Emerging Trader program. But this is going to be linked to the video. Okay. So what else is left? The last thing I have for risk is understand your product. Can anybody tell me here, if your broker fails to take you out of a contract in crude oil on expiration, what are the consequences? Can anybody tell me? Or soybeans, or corn, or wheat? What are the consequences? Yes. So it's delivery. That's right. So here's what I want you to be aware of as a professional trader. You need to go to the site of the product that you're trading, and you need to come down here and look at settlement method. If it says deliverable, you are an absolute idiot to be trading into expiration, because you'll have to put up $66,000 or whatever crude oil is trading at currently, okay, times 1,000, because each contract represents 1,000 barrels. You will receive a bill for $66,000 or $64,000 or wherever it's at today, and they'll be asking you where you want 1,000 barrels of crude oil delivered, because it is a deliverable product. It's a physically deliverable product. Okay, so don't be that guy. And you can't rely on your clearing firm, and you cannot rely on your broker to take you out or to warn you because you went on vacation long crude. Okay, Now, other products, so if I go and look at S&P Mini, okay, and I look at the contract specs and it says financially settled, what does that mean? That means that at the end of the day, at the end of the expiration period, you're going to get a debit or a credit into your account. Here's the problem with that. You want to close, you don't want to take expiration risk, because if you hold a contract, and I've seen people do this when I was watching risk at a brokerage, the problem is if you hold an S&P into expiration because you're like, I don't care, whatever, they're going to give me cash anyway. Here's what happens. The product expires, but it doesn't come off. It doesn't come off your platform on the expiration day. So it looks to the risk system like you still have that position. So it limits what you can do with the rest of your tying up margin for that position. 1. 2, you're leaving it up to the market to decide what your exit is to be. And so you have to go through the settlement procedures, and the market then the exchange then takes the last 30 seconds of trading and averages out the price and so on, and determines what your settlement price will be. Kind of a mentality where you're just letting someone else manage your risk. Don't do it. So if you're trading and you have not studied this sheet here of what expiration is, when rollover is, when the options expire, and so on, then you should do so. If you don't, you're taking expiration risk. So if a product is deliverable, you have to be keenly aware and remember to get out of your position on first notice day. Okay, and your broker, if they're any good, they're giving you a warning when it is first notice. That's all I have to cover today, and we're over by 20 minutes, and I don't think there's time for questions. We'll have to do an AMA or something. Let's just cut it off there. Okay, hopefully you're gaining something from this presentation. Risk is everything. Risk is your only method of realizing your edge is risk. It's the only thing you can manage as a trader. So be keenly aware of what your risk plan is and just execute your trades, knowing that risk is your insurance, is your protection. Okay. Good luck, everybody, and I'll catch you tomorrow morning. Take care.